Hi there, Andrew Thompson here from JBWere's Investment Strategy Group. Well, equity markets have continued to defy gravity in July despite everything going on in the world. So naturally, we've been getting a number of questions from clients around whether markets have in fact divorced from reality and are vulnerable to the downside. So we thought today we'd just provide our responses to a couple of those more common questions. Firstly, do second waves of COVID-19 present downside to the outlook? Well, in short, yes, and we have seen in countries where we have seen second waves come about, such as the US and Australia, they have seen the economic recovery slow down. But a couple of important points to remember here. Firstly, those outbreaks that have re-emerged have largely come under control without as severe mobility restrictions as we saw in the past. And secondly, the level of fatalities is lower, suggesting better management of the virus and less pressure on healthcare systems. So we see the risk of severe economic disruption, like we saw earlier in the year, as lower going forward. Secondly, does the massive increase in government debt levels present a major problem for the future? Well, debt levels from government's perspective are certainly forecast to reach record highs next year. But had governments not used or taken on debt to provide the level of stimulus they have, we would be in a much worse position globally. Now, in time, the level of debt will force some bold decisions that need to be made by governments, but it's important to remember that long-run costs do naturally develop over a long period of time in economies. And so we don't see this as a catalyst for any near-term stock market implications, especially when interest rates are as low as they are, meaning debt servicing costs are actually lower than they were before. Are market valuations now too stretched? Well, on some metrics, yes, looks like a lot is priced in, but there is an argument in the investment industry at the moment around what is the appropriate way to value markets, given the uncertainty around the outlook for earnings over the next few years. Now, one argument you could say is that the net present value of future cash flows or of earnings for companies is actually higher going forward, and therefore the fair value is higher going forward because we expect interest rates to remain so low for quite some time, which suggests markets aren't as stretched as they may otherwise appear. And finally, will economies struggle when support measures are recovered? Well, this is something we don't yet know, but given the nature of the crisis, we do suspect that support measures will be tapered slowly rather than suddenly or abruptly removed, which lessens the negative economic impact. So in summary, we do see plausible downside risks to the outlook, but we also see equally plausible upside risks. So we're maintaining a balanced view here and think it's hard to have high conviction over the market direction, certainly in the near term, and therefore are refraining from making bold asset allocation calls at the moment. But looking out medium term, we still remain constructive on equity markets and would use any weakness or any significant weakness as an opportunity to increase allocations to growth assets, so to rebalance back into equities for those clients whom it's appropriate. And just remember, it's easy to get caught up in the noise, and there's plenty of that out there at the moment, but what has proven to work over the long term is a disciplined approach to asset allocation, and that will help you meet your long-term investment goals. So if there's any other questions you have or anything I haven't touched on today, please don't hesitate to get in touch with your JBWere advisor. Thank you.